Welcome to the FounderVideo podcast, an interview series bringing you the latest and greatest info on B2B marketing, revenue operations, and go-to-market strategy from respected experts. Here is your host, Will Martin.
All right. So today we're here with Chris Walker, Executive Chairman now at Refine Labs. I don't think it needs an introduction, but just I'm going to make it for the people that don't know. Executive Chairman at Refine Labs, former founder and CEO, now founder and CEO at Passetto, a GTM consultancy tech-enabled, which is aiming to become a software company, if I'm not mistaken. And really stoked to have you on the podcast today. Been following you closely for quite some time now, and I think a lot of my audience has been too. So yeah, welcome, Chris.
Love it. Thanks for having me. Looking forward to diving in.
Nice. So in one of your recent episodes, you mentioned that the average CAC payback period at private SaaS companies, you said it's between 48 and 60 months, which is 4 to 5 years. Can you give him real life examples of what sales and marketing investments look like at a company that you might be analyzing, or throughout all of the companies that you analyze, to get this kind of CAC payback period, i.e., could be paying 50,000 a year for 6 cents or too much on trade show booths? What are you seeing right now?
Yeah, so I think centering it on public company transparent data is a good place to start. And so if you look at the 80 publicly traded SaaS companies that have to report their financials, the what they call the sales and marketing expenditure of net new ARR, which is slightly different than CAC payback period. It just looks at how much you spend during that time and how much net new ARR did you get, which is a more objective measurement, and not having to make assumptions around future expansion, revenue, and things like that. It's just point in time, this is how much you spent, this is how much you got. So public companies do. Over the past 2.5 years, the median of that number in a public SaaS company has almost doubled from around 125% in 2021 to now close to 250%, which would be a 2.5 year on average sort of CAC payback period, not including expansion and adjusted for gross margin. When you look at a private SaaS company that doesn't have that much market share, is not publicly traded and did an IPO, that doesn't have such a large base of current customers, maybe doesn't have all the different platforms and entry points for different places, they're at a disadvantage relative to those companies, not that they directly compete with them. And so what we've seen is the same effect has happened in private companies, but the baseline CAC payback period was like 24 months. And now we've seen about a double or a little bit more than that, driven mainly by the slowing of growth rates and the slowing of net new acquisition, now where a company would be somewhere in the 48 to 60 month range. Some companies have made adjustments to that. So an example of a company that might have been at 21 months in 2021, and then growth rate slowed all of a sudden into 2023 or early this year. Now they're at 51-month CAC payback period, and they have to make adjustments. So they cut marketing expenditures by 25%. They cut their sales team in half. They cut their SDR team in half. And now all of a sudden they're back at 19 months. And so the key thing is that this is dynamic. And as companies adjust, it'll go up and it'll come down. But over time, you eventually get forced by the financials to make adjustments. And the quickest way to get there is through smart cost cutting. I'll put it that way, not just a blanket, let's cut 50% of everything, but smart, ideally finding the line items that deliver the lowest ROI and eliminating those first. And so when we see in the analysis, if you just look at the marketing expenditures, a private SaaS company would be lucky to have a 24-month CAC payback period just on their marketing expenditures, headcount, agencies, programs, and technology. And then you think that a company is going to spend somewhere between 2 to 1 or 3 to 1 on sales relative to their marketing investment, which means that it's at least 48 months, but could be 60 or above, because they're going to spend more on sales and SDRs than they would just on the marketing investments. When you look inside those budgets, basically in the marketing budget, it's pretty fucking simple. They spend a lot of money on events, they spend a lot of money on digital, and they spend a lot of money on internal headcount. That's basically the three core buckets. Technology ends up being a relatively small expense. And while I believe companies spend too much money on technology and have an overbloated tech stack relative to all their other expenses, it's just not that meaningful. And so inside of the digital spend, companies will spend most of the money on some level of digital performance marketing to buy an ad and get a lead or get something like that out of it. So think LinkedIn ad lead gen. 90% of LinkedIn ads is spent on lead gen campaigns in B2B companies. Google advertising that's always built on a direct response conversion, content syndication that's built on like they justify it by, oh, we got an email in our database for $50. And so that's the digital spend. And when you evaluate that spend against the results and the productivity of the SDRs that follow up on those and the revenue that's created through them, it's really fucking terrible. And the productivity is very low. And on the digital spend specifically, in the growth at all costs era in 2021, when efficiency didn't matter and we could just hire more SDRs and we could hire more reps and we could spend more on digital and not have to worry if we had a big CAC payback period. And a lot of people were buying things which hid the problem, that we could just do that. And if our SDR team had to follow up with 999 people to get one meeting, who cared? And in the era of profitable, efficient growth, those processes need to be reevaluated to find efficiency and where we're actually going to get customers for an appropriate ROI. So digital spend, not evaluated properly, multi-touch attribution models will bias it, and then they'll try to spread out the credit across them and say, oh, because we had that person downloaded content syndication at that account that we happened to win 3 years later, that we should keep investing in content syndication on an influenced revenue model. I think is just totally out of whack with how the world works today. On the event spend, most of the event spend goes to national trade shows and big booth expenditures and the sponsorships around there. So think building a billboard on a building in Vegas for $250,000 for 3 days at a cybersecurity conference, and then building your booth inside of that conference for $300,000, and then $100,000 in T&E to get people there, and then $50,000 for all the people at your company and the customers to go out to a nightclub and get bottle service, and all of a sudden one event is more than $1 million, and they do that 10 or 15 times over. They spend $10 to $20 million on events, an established company. And the return on national trade shows is very, very difficult to justify just because the spend is so high. And so on the marketing side, that's where you're at. And then it's basically everything downstream flows from the problems in marketing. So then you have problems in marketing of low quality leads, high volume of low quality leads. And then what happens is you need too many SDRs because the efficiency of trying to follow up and get that out of the marketing leads into a meeting is so inefficient that you need more and more SDRs to arm the spam cannons of outreach and sales loft and send more and more emails and do more high volume activity. And so then you have like 2 to 3 times the SDRs that you need because they're searching for a needle in a haystack to get a meeting. And then all the way at the bottom, you have all of these sales reps that you decided this is how many you're going to have based on a reverse headcount model using an average quota attainment or an average number of deals closed by a rep. And then all the things upstream are not creating enough pipelines. So you have like 2 times more sales reps than you need, or the average quota attainment in a company is somewhere between 35 and 45% right now, which means that you have somewhere between 2 and 3 times more sales reps than you need theoretically based on the data. And the problem is not that the sales reps suck at closing or that the market is hard, it's that we don't create pipeline efficiently. And we've modeled not improperly to have way too many sales reps. And so the problem starts at marketing, starts at the beginning of the process. But because companies look at the siloed analytics of this is how many reps we need, and this is how many SDRs, and this is how much marketing, and then we'll use marketing attribution to tell us what marketing is doing, and we'll use, basic Salesforce analytics to tell us how many meetings an SDR is booking, and then we'll use a sales forecasting software and basic Salesforce analytics to understand how our sales reps are performing, and we'll use Gong. And these siloed analytics do not look at the whole process and realize, the whole problem is because our marketing engine is so inefficient and driven toward the wrong KPIs that it makes everything else downstream so unproductive. An example for executives that would really get this: if you work in a manufacturing facility and you're sourcing all of the different components, let's say you're trying to manufacture a car, right? So you need the wheels, you need the tires, you need the axles, you need the body kits, you need the electronics, and you're getting all those parts from suppliers in China. And when you get them in, 99.9% of them don't work. And then all your people start putting these things together. And at the end, you don't get a car that works and you throw it out. And then you have to go and rebuild the whole thing. And there's just so much perpetual waste that's created through the quote unquote supply chain that starts with marketing. And that is the fundamental issue in go-to-market, driven through the outdated planning models that companies use to project how the demand waterfall, MQL, SQL, SQO, that fundamentally doesn't scale in the world that we work in today. And so I
Mhm.
think long-winded way of saying I think that's the core issue in a go-to-market engine today.
You mentioned a couple times in that answer the world we live in today. What is the world we live in today, and how will it change in the next 5 to 10 years, especially regarding how buyers get information? Would you say that Google has become unusable for someone that's intelligent or aware enough about the market landscape?
I think it's nice to project the future, and I'm happy to, weigh in on my assumptions of where the world might be in 2, 5, or 10 years. But the thing that we need to think about is how the fuck does the world work today, and what do we need to do to run our business today? And the reality is that most B2B companies run their business based on how the world worked in 2014. And so the core fundamental difference from 2014 until now is that the maturity and scale of the internet and how a B2B buyer uses the internet to decide what priorities, to get information about what products to buy, to understand what metrics, to get information that they used to only be able to go to Google or a conference once a year in 2014 to get that information. Now they get that every day on LinkedIn, in a community, direct messages to thought leaders, online live events that happen, texting their colleagues. There's just so many new avenues through the internet that allow B2B buyers to get information from their peers, which, by the way, are by far the most trustworthy source for a B2B buyer, that um, that is the fundamental shift in what's happened. Additionally, over the past 2 years, interest rates in the US have more than tripled, potentially quadrupled, and they're coming down slowly. However, there's been a massive speed bump in the overall economy, which has slowed down growth rates across public companies, has reduced NRR and GRR significantly in most B2B companies, um, and fundamentally changed how a B2B company, especially a tech company, is now valued by investors or the public markets. And I think that requires transformational changes around how we think about go to market. And as I've been consulting more with companies, I want to highlight this key thing that I'm noticing is that there is a core disconnection between the finance team and the go to market team. That the finance team doesn't understand go to market enough to weigh in. So they're building simple models, and the go to market team doesn't understand finance enough to be able to put together a model that finance trusts. And there's a core disconnection about how those two functions collaborate and work to build a model that's both realistic, attainable, and delivers profitable, efficient growth. And I need to spend more time studying this, but there's a clear issue here where if companies need to, reduce cost of acquisition, instead of being smart around, okay, whereas we spend $15 million on marketing right now, what should we spend? Let's go look at the data, understand, should it be 11? Should it be 12? How should that be split between programs and headcount? How do we look at data to make that decision? Finance will just say, we're cutting by 50%. Go figure it out, CMO, figure out what you want to cut. And I think we need to be a lot more strategic and data driven between these two functions about how we make those types of decisions moving forward.
We'll cut your LinkedIn ads costs by at least 50% with natural-looking creatives that prospects actually want to consume. Just have an expert in your C-suite show up to a 90-minute interview once a month and let us take care of the rest. Turn LinkedIn ads from an accepted line item expense into a scalable revenue channel that fits into your go-to-market strategy. Book a free consultation at FounderVideo.io.
Yeah, I like that in one of your episodes you mentioned that what you're doing at Passetto now, like, since you started, all of your messaging has resonated a ton with marketing leaders, but now with Passetto, it's starting to resonate more and more with CFOs, CROs, CEOs, right? Because we're talking about business metrics, not necessarily just marketing KPIs or sales KPIs, right? And something that impacts, as you said, the valuation of a company, especially in this efficiency era, it's getting more and more key. Talking about that, Passetto is focused on signal-based analytics, right? Among all of the companies that you guys have worked with and are working with, what are the top 5 right time signals that companies should be looking for from ICP fit accounts when trying to find the highest ROI outreach trigger? Apart from pricing request and webinar attendee, because I know you mentioned those two.
Yeah, I mean, the fundamental root of the issue is that B2B companies don't track 70% of the signals that lead to revenue. So if they should use a signal-based analytics methodology, 70% or more of their revenue, they don't know, they can't trace it back to a signal. And so the short answer is, like, I don't know. It could be intent data. It could be a cold list for a target account. It could be something that you get from first-party de-anonymized websites, but the reality is that B2B companies don't track that. They just know that the SDR got a meeting and that was the rep that closed the deal, so we can comp these two people about the performance they did, but they do not have the clear data to say, okay, so what should we do next? How do we think about our focus and prioritization and strategic initiatives moving forward? They just lack the data to be able to do that really effectively from my view. And so where does that leave you? They track some of the data related to first-party signals that are traditionally known as marketing signals, and obviously a hand raiser is the highest performing, but even within what people would call a hand raiser, between pricing requests, demo requests, contact sales, contact us, chat, you'll see pretty big discrepancies and disparities between the performance of just those 5 things that some would view as all a hand raiser. Webinars also perform really strongly relative to the other events, mainly because webinars are far more cost effective. But to really confidently have the data around these are the top 5 signals for a B2B company, it would require you to track those signals comprehensively for a long period of time. And B2B companies just don't connect first and third party signals in a comprehensive way right now.
Yeah, looking forward to see Passetto, like kind of diving into that. I think as you mentioned the concept of an auditor of signals that could, identify in a certain vertical sector, right? Like HR tech, for example, or companies between 100 and 200 million in the US that has so much experience in data that has worked with regarding signals that could tell, hey, for this company, these are the signals that you might want to get more of, because we've seen across the board that are working the best. But for now, as you mentioned, right, I think it's more so of an experimentation that every company should do inside their company in a specific case, because they cannot make decisions if they don't start tracking first and foremost, right? Also,
it'll take years to have large scale aggregated data that's collected in a comprehensive way across a lot of different companies to draw those types of scientific conclusions. A lot of the quote unquote science and reports that come from companies right now are total horseshit. And when you look at a tech company that uses a research report or like some type of report like that as a way to do marketing for themselves, they're not doing science. They're trying to spin whatever they can in order to sell more of their product. And I think that we need a different type of firm that understands science, understands statistics, understands statistical significance, understands how to run controlled experiments, understands how to aggregate and standardize data in order to really do some of this research that I think a lot of people would find valuable. Even benchmarks that happen today are totally inaccurate. To take a survey and say, what's your CAC payback period, and have a VP of demand gen try to put their CAC payback period in. Are they measuring marketing CAC? Do they include headcount? Does it include post-sale and expansion ARR, or just net new ARR? Every company's putting in a different number. None of it's validated, and it's just a bunch of garbage. And so I think we really need to challenge the way that the data that we're getting in and how we're using that data, and to question, is this data actually valid? Is it actually helping me make decisions? I think there's a lot in my background of, clinical trials and understanding we're going to put this patient on this product, and if the product fails, they're going to die. Are we going to put them on this product, or are we going to put them on the product we've been doing for 40 years that we know performs X, Y, and Z consistently? And I feel like that level of scientific rigor in the future is required in B2B companies that just hasn't. It's all a marketing exercise right now for tech companies, and that's the research that comes out. And I think that we need a lot more scientific rigor moving forward, and that's part of what I'm trying to do, because I think that it'll just give companies a data that they can trust, benchmarks that they can trust, large scale aggregated data to calibrate and understand. Are we way underperforming or way overperforming? Hospitals do that. Hospitals say, okay, every patient that comes into the ER that has COPD, what's the disposition of that patient? Do they get admitted? Do they go to the ICU? Do they die? Do they go here? Do they get discharged? How do we perform as an emergency room relative to the other 5,000 emergency rooms in the country? That data is collected comprehensively. It's collected consistently. I just think that a B2B company could take a similar approach, and the stakes are way different. It's not like if we fail in a B2B company, someone's going to die. The stakes are different, but I think the scientific rigor should be treated the same or modeled off of that.
Yeah, 100%. You mentioned a lot of times that one of the biggest problems with signal-based analytics is that B2B tech companies usually have a survivorship bias, right? That is huge and makes them only track the one signal that worked, and the 99% of times that it didn't work, either the data gets overwritten in Salesforce, or it was just not tracked, right? Because the only way they track signals is in order to know how to comp the Salesforce. So you mentioned once in or many episodes that a possible solution could be the custom object inside Salesforce to not let that data get overridden as we track and timestamp all of those signals that we take actions against. How do you see Pesetto building a pipeline architecture that enables companies to measure this properly?
Yeah, I think this issue exists when it comes to signal analytics and having a unified pipeline architecture from when the marketing dollars get invested all the way till when sales close won the deal and that whole process. But there's a survivorship bias across the entire go to market in every way that they build a report. Every report is built to say this is what worked, this is how good we're doing, this is why we should keep investing in my program. All the reports get built bottom up. So the events manager has their own technology and analytics to show how good events are working. And the digital person buys their own tool to show how well digital is working. And the PR agency is producing something to show how much PR is building their brand. And the content and social media team and branding team has their own stuff. And what's happening is basically the bottoms up reporting that comes from the budget holders then gets layered up into the CMO. And then the marketing report then goes into the go to market deck. And when you look at it, you're like, wow, everything is working so well today. Everything's working so well. Well, then why the fuck is our CAC payback period 51 months? It's impossible that all the investments that we deploy are working so well when our business metrics are not performing. And so I think we need to completely flip the paradigm where analytics solutions always start from the bottom up. Think multi-touch attribution, think sales forecasting, think sales engagement platforms. They start at the tactician and then they help prove that the tactician is doing a good job. We need to flip the paradigm where we start at the top, net new ARR, sales and marketing percentage of revenue, ACV correlated with sales cycle length, sales velocity trending over time, and look at those metrics and then build our analytics down. And you'd come up with a fundamentally different way to model, plan, forecast, and analyze your go-to-market when you start at the business metrics and work down versus starting to try to prove why everything's working and work up. And so that is in its own way a survivorship bias. When you look at the signal analytics, basically because of how the data is disconnected between the contact, the lead, meetings or activities that happen through an SDR, campaign members that get tagged on records, accounts, opportunities, and all these different objects, and then the way that the data is tracked is that every single time, and B2B companies didn't really track this at the beginning, where it didn't matter if your SDR team lost 99 times in order to get one meeting because we were in the growth at all costs era. Who cared? It didn't matter if an MQL from marketing only got to a closed one customer at 0.1%. Who cares? We can make the math work. Our revenue multiples are 25x. Who cares? And all of that reporting and process has not changed based on how the landscape and the economic environment has changed. And so I think that moving forward, the fastest way to optimize your go-to-market strategy fast is to look at all the things in times where your sales team, your SDR team, and your marketing dollars are losing, aka not performing clearly based on signal-based analytics, and systematically eliminate them and then reallocate them to things that are proven to work or to net new experiments, and likely put a lot of the money that you save back on the bottom line and improve EBITDA. I think there's another, like when we think about the sort of disconnect between revenue leadership and finance and the CEO, and this disconnection is that these two groups care about fundamentally different things. It would be incredibly rare for a CMO to say, my budget's $18 million and we're getting a 30-month CAC payback on the marketing budget. I'm going to give $7 million back to the company next year, and my budget will be $11 million next year. You would almost never fucking hear that. What you hear is, oh, we don't have enough budget. And so what the CFO and the CEO need to do versus how the revenue leadership is thinking and operating, there's a clear disconnection in a lot of cases where what I'm seeing right now is that CEO and CFO are starting to push these changes down to revenue leadership rather than revenue leadership bringing them up, which I think is a really interesting insight and a really interesting sort of angle that tells me that these two groups are not thinking in the same way, and these two groups are not fundamentally aligned on what matters to the business, despite them all being in the C-suite. And so I think that's another interesting data point, anecdotal right now, but what have I done my whole career? Worked with a lot of incredibly accomplished, smart executives, great companies, great investors, found patterns of the problems that all of these super accomplished, super smart people have and helped them try to solve them. And so this is a pattern that I'm seeing right now. And I think the message is that we need revenue leaders, CROs, and CMOs to start being more informed and to start thinking more like a CFO, to understand those things more, to look at top level business metrics and start making changes to their teams and departments that support those overall goals that drive enterprise value.
Couldn't agree more. You've been, looked at or like, you're one of the biggest icons, I guess, of demand creation at this point, I think. And a lot of people talk about how, Finn, when he interviewed you, he mentioned that you're driving like 10x or 25x what an SDR can drive in terms of, pipeline and revenue from your personal brand or from the podcast and all of the demand gen activities that you do. How, like, from your experience and what you've done in the past 5 years with Fine Labs, what would you say, like if someone asks you like, hey, I want to start doing demand gen and I'm tired of, chasing and spending a bunch of my budget in the most inefficient process that it is to convert an in-market lead into close-won revenue, and I want to start educating my market at scale and all that, how to do demand creation in a way that generates signals that companies can win at 10% plus win rate instead of 0.1% as they're doing with lead gen.
So just coming up with an idea and saying we're going to do demand creation now at your 100 million ARR company is 99 times out of 100 will fail at this in this economic time. And so here's the process of how to not have it fail. It's to, one, start at the top level business metrics. What is our sales and marketing percentage of net new ARR? How does that break down between net new revenue and expansion revenue? How do our expenses ladder up to the differences between how much we spend to create pipeline with SDRs and marketing dollars versus how much pipeline we create? How much money do we spend with solutions consultants and AEs and all the part of the process to close net new customers, and how much net new business do we get? How much money do we invest in post-sale and customer success and AM and things like that? And how much NRR do we have, and how much renewal business do we get from that? And break the process down and then start to look at and say, okay, well, in every company, the most inefficient part of the process is going to be in-market account to net new closed won customer. Most of the go-to-market sales and marketing investments are going to go there. And it is highly inefficient when you think about how companies acquire new logos. And so then run a data analysis and say, okay, where are all the marketing investments that go to support this part of the process? Basically all of them. And what are all of them? Direct response lead gen channels, so our SDR have a signal to call someone against. Okay, now let's track all those signals and look at how inefficient they are. And then you can quickly find, okay, these are the small amount of investments that we make that drive strong results, a portion of branded, paid search, much branded, but maybe you'll find some gold and some non-branded keywords, probably your SEO strategy, some other level of content potentially, and you'll see that clear data, and then present that to the company and say, okay, we spent $300,000 on content syndication last year. We got 600 leads from it, or 6,000 leads. I can't do the math. Let's just say 6,000 leads. Out of those 6,000 leads, our SDRs called them. We got 17 meetings, and out of those 17 meetings, we won one customer. And you can literally make calculations and say, this is how much it costs for the SDRs. This is how much the marketing dollars cost. This is how much it costs us for our agency to do that. This is how much it costs us for our sales reps to work 17 deals and only win one of them. And here's the total cost that we put in, and we got one customer for 37K ARR. And you can present that to the executive team and say, this is a net negative across our entire go-to-market. I would like to cut this expense, and I would like to reallocate it to things that work better. And part of that is going to be focused on this new part of the process, this important part of the process that we underfund right now, called getting our target accounts to want to buy our stuff. And if you look at the investments that companies make across that spectrum, less than 10% for sure. Many companies, less than 5% of the total go-to-market investment is focused on getting a net new account to want to buy our stuff. Dramatically underfunded, one of the number one problem in creating predictable pipeline for companies, which to me is actually the number one issue in B2B companies right this second, is that they cannot create predictable pipeline at an appropriate cost. Their sales reps, they have too many sales reps, but it's not like all their sales reps suck. If their sales reps had pipeline, they would close deals. It's actually a pipeline problem and an efficiency problem in creating that pipeline, as I continue to think through what the core issue is. And a lot of that is driven through the modeling and the planning and the core KPIs, as I've mentioned. So yeah, that's some of the things I'm seeing right now.
Mm-hmm. Yeah, but in doing so, when you reallocate that budget and decide to start getting your market to want to buy your stuff, what are the things that someone cannot miss, or what is the right way to focus? A lot of people try to, but they just don't, because they come from a different mindset or they're using different models to measure it and whatnot. They might try it out for 3 months. They start doing content on LinkedIn, they start doing a podcast, whatever, and they start doing this other initiatives. And because their models tell them that they're not working at the time that they need it to be working, then they stop it before it can work, or things like that you've seen time and time again.
Yeah.
What would you say to that?
Yeah, I want to talk through first, like, okay, so as we shift this budget, how are we going to know whether or not it's making an impact for our business? And a lot of people, when they shift the money to demand creation, they say, oh, when we do this, we're going to get more demo requests, something that I popularized and I do think is an interesting leading metric, but I think it's nowhere near comprehensive to calculate the impact. And so when we make these changes, we need to be rooted in top level go-to-market performance metrics, not how many demo requests we got. We need to be looking at, how did that impact our sales velocity? How did that impact our total pipeline creation as a business partner, outbound, marketing sourced, all of it? How did that make an impact over 90 days on our projected CAC payback period, or how much pipeline we get for every dollar we spend? But when you center on those types of metrics and you execute demand creation properly, it becomes very, very, very clear that this is driving positive business performance, but it cannot be measured against MQLs or some narrower set of MQL creation. Inside of demand creation and the programs, number one, create a live show that you do every week for your target customer, where you offer the best free consulting to your target customer every single week with someone that's an expert that they trust. If you don't have it in your company, go find an influencer, pay them $10,000 a month to be the host of your podcast, and have them do it. And put that together. Then that weekly event, maybe you get 100 of your target customers to show up every week. And then all of a sudden you then convert that into a podcast. And then that podcast then becomes LinkedIn content that you put out on personal pages. And then you take that and you put it on your website, and that becomes a form of your email marketing strategy to send out those insights every single week. And then you put it on YouTube, then you convert it to YouTube Shorts, and all of a sudden your stuff is showing up in Google search. And from an organic strategy, you've done the most effective thing that you can do in marketing at a relatively low cost. So I think that's the number one. It's hard to execute. Why? Because B2B analytics do not support it and are not built around it. And number two, you really have to understand your customer and go in with the right mindset, which many B2B companies struggle to do. But that's number one. Then having your target account list. You have your strategics, you got your tier ones, you got your tier twos, you got your tier threes. Depending on the ACV and the average deal size and the LTV of those companies, maybe some of them you don't even advertise to. But if you're tier threes, you're still selling a 35K deal, then having those 500,000 tier three accounts inside of your CRM, building custom audiences inside of LinkedIn and Facebook and other places, and marketing to a tier three account in a one-to-many motion is a great strategy. You can reach those accounts and give them your message for somewhere between 0.5 cent and 6 cents. An executive at one of those companies, and having a more focused, personalized strategy on strategics and tier ones, and having an advertising strategy built around getting your customer to understand your product and want to buy, rather than how do we get this person to submit our lead form, is another fundamental shift in how I think B2B advertising budgets need to change. The core objective around them, I think, is the major flaw. there's significant large-scale data that shows that B2B companies spend 90% of their advertising budgets on social media channels, on lead generation campaigns, and win those customers somewhere between 0.1 and 0.2%, 1 out of 1,000 to 1 out of 500. And the advertising CAC paybacks, or the advertising CAC, is around $50,000. Does not include agency costs, internal headcount, other technology, all the other programs you run in marketing, the SDR cost, the sales cost. So maybe you can justify it for $1 million ACV account, but pretty much any other account that's in the 100K, 50K, 30K, that model just doesn't make sense. And so I think that's a great strategy. I think that companies that run, and this isn't really demand creation anymore, but I think companies that run product-oriented a group webinar around their product, an example with like blanket data about how you could use their product, a group demo that happens every week. I think those are great strategies that take an interested buyer and get them into pipeline. I think that's a great strategy, but not necessarily demand creation. And then like bigger companies will look at like analyst relations and other things like that, which I see value from. If you look at the Gartners and the Forresters, what are those companies? They basically do two things together. They help you decide what technology to buy, and then they try to give you advice on how to run a specific function, marketing, sales, engineering, product, something like that. I think a majority of their research and benchmarks and things like that around how companies should run their go-to-market are severely flawed and not helpful. But when it comes to paying this company $40,000 a year to have them recommend your technology and put them in a quadrant or whatever it costs, I think that's a good buy for most companies. It's pay to play. It sucks. I don't think that it's fair, but that's how I think it's still an influential part of a customer's buying process and getting you on the map of the consideration set. So I think that has to continue to be included in the mix for right now.
Interesting. Yeah. And when it comes to demand creation, how do you set up a proper self-reported attribution infrastructure that can properly track the impact of dark social content and all of the buyer's journey that happens without us even noticing these days?
On the main hand raiser conversion forms, which most companies will have a button in the top right of their thing that says contact sales, request a demo, book a meeting, it'll say something like that. On that form, where a majority of your existing market demand that wants to buy will flow into, take out the field that says, what can we help with? And put in, how did you hear about us? Because your sales rep can ask, how can you want my help? It's probably the first question that they're going to ask on a sales call anyway. And put, how did you hear about us? Open text field, not a drop-down menu. It biases the results and it limits the results. Required, not optional. We need all the data. And if somebody's not going to tell you, at least they're not going to put NA or nothing. If they're not going to put anything in there, they're not qualified to buy from you. It's actually a mechanism to weed out spam, unqualified submissions. Free text field and required. And then through that, you have the qualitative insights that those submissions should get pushed into Slack directly. Submission, first name, last name, company, account, target account tier, self-reported attribution, job title. Everyone in the company can see every submission and they can see what someone said for how did you hear about us. And every person in the company will start to see that stuff. And then they'll notice, hey, CTO, tier 1 account, said they heard about us on a podcast. That's a great signal. Then everyone in your company can see that data, not just marketing running a spreadsheet report for their marketing report. So pushing into Slack, I think, is a highly underutilized way to get the rest of the company to see and value this type of stuff. Then on the back end, you can process all of it and you can use either AI or string automation to be able to say, okay, this person said podcast, or this person said revenue vitals, or this person said Chris's LinkedIn. You can start to categorize that into LinkedIn and podcast and social media and other categories. And you can make reports around that and say, okay, 40% of our submissions say they heard about us in Google search, but only 10% of our pipeline comes from where people said they heard about us in Google search, which means that a lot of the low quality submissions are people that are saying that we heard about us in Google search. That's an insight. For us, our sales team is the number one thing that they want to work is when a target account, a good fit account comes in and so they heard about us on the podcast. It means that by far the most educated customer that prospective customer that they're going to talk to. It's a great indicator for sales, and the data supports it. So I think it's a very simple way to set that up. People will consistently say, "Oh, but if we put this field on the form, it'll reduce conversion rates." And test after test after test with companies that have the same objection. You put the field in the form, and you don't see any significant decrease in conversion rates. And oftentimes, conversion rates go up, and conversion rate to pipeline goes up. That objection that's not at all based on data, and it's just a reason to say no to try something new, I think is based on data, no longer a valid objection.
Hmm. You mentioned the podcast, and I wanted to ask you about your journey growing Refine Labs, because I think it's remarkable to grow a company from just 5,000 a month dollar client in 2019, I think it was, right, to multiple eight figures per year in revenue. I've listened to the must listen episode that you dropped recently about that whole journey and what actually happened throughout the years and whatnot, all of the hurdles and challenges. But I wanted to ask you, like, would you say your podcast or doing, the live show on a weekly basis was the biggest lever that you could pull to grow Refine Labs, or was there something else that you would highlight as really really key, maybe regarding hiring or culture or whatever it is, that was critical to the growth of Refine Labs?
The dark social strategy, from live event to podcast to LinkedIn, was an incredible marketing execution that was way ahead of its time. And so I think that had a large impact in people knowing that we exist and understanding the problem that we solved in our differentiation. But there's a hidden benefit of doing that event, which is that you get rapid feedback from your target customer very, very fast, which helps you iterate on the product and what you build and how you message it on the website and all these different things. It also became one of the core sources of how we hired the best talent in the industry. And so it's not just to get customers, but it was for hiring talent, and it was for iterating on messaging and strategy and the direction. And so that was just a huge benefit for a variety of reasons. In addition to that, I think that our hiring strategy and the type of person that we looked for and how we evaluated their talent was a huge impact in our overall success as a company, from an executive level person all the way to the people that build the content and the creative and run the media and all those different things. I think our process for attracting talent, evaluating talent, and then training talent once they're in there was one of the key reasons why we were successful as well.
And what were those things that you guys were looking for? And I'm assuming that, those are in line with what you're looking for right now at Passetto as well, right?
Yeah, I mean, through the live events and the podcasts and things like that, you basically are attracting the people that see the same problems inside of their own business. And they can go in there and they can try some of the things that you're talking about, and they can see that they work. And all of a sudden, they are way more interested in working for your company, where they don't want a new job. They're fine where they are, but they're so attracted to what you do that you're able to pull talent from one place into you, rather than trying to fight over someone that's out there not happy with their job looking for a new job. And so it's a very different talent attraction strategy that I think is really interesting, that gets you a different type of person in a different part of their career journey. In the evaluation of talent, we had specific parts of the process that would evaluate specific things: CRM data analysis, ability to analyze a paid social account or a Google Ads account, and then present their findings at an executive level. And those parts of the process basically would weed out 80% or more of the demand gen talent. Um, and we personally probably interviewed 200, director level or above demand gen people in the past 5 years, and our company's probably interviewed 500 or more. And there are a lot of people that hold a great title at a great company that don't know what the fuck they're doing. And so I think that, and many companies do not have a clear process in how to evaluate whether a director of demand gen really knows what they're doing or not. And so I thought that was the evaluation of talent, I think, was another key part in being able to identify who are the people that really understand this and can critically think and can make, and then present that to an executive in a way that's compelling and smart, I think that was another key part of the process.
Interesting. Two questions regarding other companies. You mentioned when talking to Justin Norris and Rev.fm that the signal analytics landscape, there's signal aggregators, well, signal providers first, right? Signal aggregators and then signal analytics, and you only see Passetto in the signal analytics category, if I'm not mistaken. Would you add any other tool that could drift into signal analytics eventually, or that is prone to do so? And how do you see the landscape evolving? Because you mentioned, Reggie.ai and others could be consolidating other tools that are still being used. I want to get your take on that.
Yeah, I mean, signal providers and signal aggregators sell data. Um, and so those types of tools are not going to be in the business of building a custom CRM implementation and then trying to track and analyze them. It's just not their core competency. And it would be very, very different than what they do today for not that much impact. It's just like why SalesLoft and Outreach have the fucking worst analytics around sales engagement performance. They're like the super basic, they don't actually help you. And so the people that give you either data or help you automate or optimize a process are typically not in the business of also analyzing those processes. And if they are trying to be in the business of that, their analytics are biased to help you continue to buy their platform. And so I think having a distinction and a separation of church and state that says these are our providers and these are our analytics vendors, I think is a very interesting distinction that people should start to consider. Signal analytics is a very new category. I think it's one thing that Pesetto is centered on today, but I see a much larger vision for what we're building and doing. It just happens to be a very clear path that is differentiated right now and very important for companies. That is something that we do. I don't see companies trying to do this right now. I've been talking about this for 2 months, right? So even if a company is working on it, no, it's not visible right now. And I think that, again, when you think about signal analytics in a lot of ways is a bottoms up reporting framework. I think it gives you great insights if you look at it through the lens of we're trying to figure out what's not working, not try to prove what's working. You can shift it and make it very useful, but it still defies the law of we need a tops down framework. So when you think about a tops down framework, business and financial metrics first, go to market breakdown based on create pipeline, close net new customers, expand accounts next, and then you get into signals below that. And so I think it's a method to optimize investments, but I don't think it's the core starting point or the main thing that we're doing at Passetto long term. It's a component.
I want to tap into that. You mentioned the bigger vision for Passetto, and I know in former episodes you mentioned that Passetto is now looking more like what McKinsey could do, or other consultancies, big consultancies. Why do you think so? And what is the direction that Passetto is taking in that sense?
Uh, what's the core focus of Passetto? Dramatically improve enterprise value and growth rate for companies. How do you get improved enterprise value? Number one way in a B2B company is to get more pipeline and net new customers for the same or less money. Improve go-to-market ROI is the number one way to improve enterprise value in a company. Increase your valuation, increase your ability to IPO, increase your growth rate. And so what is the actual, it really framed on what are the outcomes that you're driving. And number one would be increase enterprise value driven through a more efficient go-to-market engine and through connecting finance and revenue leadership in a way that allows them to plan more appropriately and deliver for the board. And so when you look at the top level, like that is what McKinsey would do. Maybe they're doing it in a different way. And I don't want to compare myself to McKinsey because I think what we're doing is fundamentally different. A lot of McKinsey is people that went to business school and got an MBA. Like we worked in the trenches and go to market. I worked in the trenches and go to market for 15 years, and I really understand finance. And there's a big difference between understanding finance and trying to bring that into go to market versus understanding go to market and then really understanding finance. And I think the path for the people is you need to really understand go to market and then learn or really understand finance, not the other way around. And so I think that in this particular space that we're playing in this particular, company set and the challenges that they face, I think that we have a very unique differentiated offering related to the connection between go-to-market and finance. Layering on top of that, we have an aggregated database of 52 companies: churn, NRR, growth rate, ACV, sales cycle length, pipeline velocity, trailing 6 quarters, how much they spend on marketing versus sales versus post-sale. An incredible set of benchmark database, mainly for mid-market companies, 30 to 500 million in revenue, that provides real, accurate, human validated. We validate the data when they give us all their Salesforce data and they give us their financial data, that the data matches up exactly based on code. And when you fill out a survey, there's nothing like that ever being validated. Even with public company data, it's hard to get there. And so we'll build the most accurate benchmark database for top level go-to-market performance metrics that exist, focused mainly on mid-market companies that feel this problem the most, in my opinion. And then deliver strategic consulting around whatever our customer needs to improve those core metrics to improve enterprise value. And so there's been a shift where initially we were pretty centered on building a product company, and purely by listening to our customers. What does our customer find the most valuable? Where are the gaps in the market where we're differentiated? What is it? It's by helping the customer know what to do next. And software tools don't provide that. Experts do. And so instead of being romantic around we want to build a tech company, we're going to listen to our customers and build what our customers need.
Love that. Love that. What questions should we ask ourselves about an account to figure out what is the right channel and message to reach out to once we know that it's the right fit and the right time? And how do you see AI taking over this process?
Ask that one more time.
Yeah. So what questions should we ask ourselves about an account that we know is the right fit and the right time to reach out to, but how to figure out the right channel and the right message to reach out with? And how do you see AI taking over that process?
Yeah. So in the order of operations, you need right fit. So you need right account that can buy from us, and then the right person or people inside of that account. That's step one. There's a lot of ways to get that done. Strategy. I don't think that historical CRM data analysis, while it does give you some insights, it's a reflection of what you did in the past, not what you should do in the future. And so I think a lot of what you should do in the future should be driven by go-to-market strategy, product marketing, qualitative customer insights, identifying those things to decide who we're going to target in the future, win-loss analysis, understanding what current customers find most valuable, what's similar about them. It's a lot of qual and strategy. Then you have right time, which is determined by the signal. What signal do those accounts send us? So next step would be setting up a unified pipeline architecture that extends the definition of pipeline beyond just opportunity created to close one, but actually signal or where sales takes our first primary action all the way to close one, which opens up a whole new set of data around how to run our go-to-market machine. And then after that, you have right message, which could include the words that you say and the channel that you say them in: email, LinkedIn message, phone call, AI voicemail drop, whatever. And inside of that segment, with the upstream data of right account and right time, then all of a sudden you're ripe to automate with AI. It's going to be faster. It's going to be more consistent. It's going to be able to learn better. It's going to be able to analyze data better. It's overall going to be better. Someone smart is going to have to run the machine and monitor the machine and give it new inputs and new ideas. So it's not like we're just going to have this thing go rogue and do whatever for our customers, but it will be able to deploy messages and test things a lot more effectively than a human would. And so I see a lot of opportunity there. I already get voicemail drops from AI. Is it effective for me? No. Is it effective for someone? Maybe. Is it way lower cost than having a human make the call? For sure. So I think there'll be clear ways for AI to optimize the outbound cadences that humans do right now in the future, and many companies are already trying it. The main benefit that you get today is that AI costs way less than having a $100,000 SDR do that manual work. So the main benefit they're getting now is in cost efficiency. And I hope that over time we would see benefits in effectiveness as well.
Love that. You mentioned, and just to wrap up, because I know you got another thing right now, but You've mentioned multiple times that the Bowtie framework from Winning by Design that flips the funnel and makes it a bow tie, right, with the expansion and retention side of things as a growth engine can help paint an image of what pipeline architecture should look like in a GTM unified team, and especially regarding single base analytics. How do you see Passetto and the way we should look at structuring data from signals and other parts of the GTM strategy fit into this bow tie?
I appreciate the bow tie framework for the up level of science that it creates around the definitions and the conversion rates and the volume and velocity between stages. So I think there's a lot of benefits there. However, I think that right now that whole system lacks practicality around, okay, how do we get this implemented in our CRM? Is this monitored off of the contact object, the account object, an opportunity object, or a custom object? What data should be collected on that thing? What are the 57 things that we should track on that record that are all standardized and important? And so while the high level framework makes a lot of sense, my assumption, I need to do a little bit more digging. I've spent some time with Jocko and the team that have done this, which their work has definitely moved the ball forward. And I see them being a replacement to that model being a replacement to the demand waterfall moving forward. And I think that they could be the new Forrester and producing a lot of great insights there. The same issue that happens with Forrester, however, that will happen with Winning by Design is that they lack practicality of, okay, how do we put this theory into practice in real life and make it work? And that's sort of the connection point that we have with Pesetto, which I think opens up a lot of interesting partnerships. So our objective is at Pesetto is to have our unified pipeline architecture be compatible with the bow tie framework, but provide so much more granular insights that help us make decisions at a much lower level as well.
Love that. Yeah, sorry, I got the.
All good.
No, right, I've been taking on some stuff from Winning by Design. I agree with you. The practicality was missing there. It's a good model and it makes a lot of sense. But like, how do I take this into the CRM? Right? You mentioned the custom object. There's so many options, and the I think the root cause of the problem there is that most CRMs, most analytics tools, most BI platforms, they're not built to build this kind of pipeline architecture that's unified and that gives us an actual reliable and trustworthy source of truth for GTM strategy data, right? Did you think so, or what's your take there?
Yeah, but we're just early. Like, and when you think about how technology ecosystems are built, a Forrester or a Gartner will create a model like they did the MQL waterfall in 2004 and then updated it in 2011. They'll create that model, and then all the tech vendors that pay them will then build their technology around the model. And that's where you get the automated lead gen machines and the lead to account matching and all the other technology that gets built on this MQL, SQL, SQO1, sales, marketing, SDR tools get built around that core model. Then all of a sudden, Forrester makes an update in 2017 around account-based. And then all of a sudden, you have the account-based marketing technology. You have the influence revenue reporting, all these different marketing mix modeling software that are getting built around this new model. It's clear from 2017 to 2024 that the world has changed a lot. I think that this new focus with Winning by Design, I think, has the opportunity to be the new sort of model and platform that the tech ecosystem is built on in the future. And eventually technology vendors will have to basically bet on a horse. Am I going to bet on the old Forrester model? Am I going to bet on the new Winning by Design model? And we'll see that play out over time. So I think that it's an interesting thing to see develop. And we'll see what happens.
Yeah, looking forward to it. I mean, you're right. We're super early, but I cannot wait to see that image and what can that do to companies, right? Being able to have that unified GTM view that you keep talking about. So yeah, really interesting stuff. Yeah, Chris, it's been a pleasure. For everyone wanting to find you out there and wanting to learn more as well. I know you have some resources for people that want to implement this in their companies and whatnot. Anything you would like to promote or shout out to?
Yeah, everyone, thanks for listening. If you got this far, really appreciate it. Hope it was valuable. If you want to learn more, feel free to subscribe to the B2B Revenue Vitals podcast on Apple or Spotify. I produce 3 episodes of that content a week. This episode that we just recorded will go on it. There's tons of different insights on B2B financial, the financials and economics that is, helping revenue leaders understand what's happening at the board level and the CEO, CFO level. Signal-based analytics that gets a little bit more tactile. We talk marketing and sales and outreach and demand gen and ops. So really a comprehensive view about what's happening in B2B go-to-market. Most of my insights come from mid-market companies. And so if you're like a $1 million ARR startup, I'd love if you listen to my stuff, but also it may not be totally applicable to your situation. I've decided to niche down and really focus on the companies that we think we can help the most. And so just a little caveat there as you think, because I think it's really important now that content has become so commoditized on the internet that not only we're just looking to seek out information, but also having a real scrutiny around, is this information applicable to me in my situation, is a question I think we need to ask ourselves a lot more when it comes to content consumption and how we use that to make decisions. So I want to pioneer the way and be clear on, for people about the caveats on when my information may not be right for you. And I think that is one particular instance. So appreciate you all listening. Feel free to subscribe to that. You can also find me on LinkedIn, Chris Walker 171.
Awesome. Pleasure to have you, and hopefully looking forward to have you back at some point.
Amazing.
It's been a pleasure.
Thanks, Will. Great interview.
Thank you for listening to the FounderVideo podcast with Will Martin, and we'll see you on the next episode.